Good morning, Emily.
Good morning, Dan.
What is on the agenda for today?
Long term care insurance, health insurance in major health events, and, wait for it, homeowners insurance, or more specifically, the business of property and casualty insurance.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, an insurance triple threat, but with some specifics on the back end. So hit me. What do we want to know about? I'm going to guess long-term care first.
That's right, I want to start with that one. I mean, first of all, I just want to know more about how it works specifically. I think there's a lot of misconceptions around it.
Sure. So first and foremost, let's just talk about what long-term care insurance is for. Most people generalize long term care insurance into being care for somebody who is in old age. Who needs to go into some sort of assisted living facility or care facility, but technically that's not the criteria. It's not that you have to be like over 80 or something. The criteria to trigger long term care insurance and the issues that trigger long term care insurance is the inability to complete two activities of daily living, or ADLs. The activities of daily living are things like feeding yourself, bathing yourself, sitting and standing, dressing yourself, being able to use the restroom, which sort of goes hand in hand with the sitting and standing issue. But essentially, just that your mobility or faculties are impeded such that you need either a significant amount of assistance or you need consistent and ongoing assistance to maintain a basic quality of life.
And is there anything specific around the age? Like if you needed assistance with those things younger, when you're younger for some reason, can you still get the kind of insurance and use it?
Yeah, you can. So, I mean, imagine a scenario, let's say, where for some crazy reason you're in your 30s or 40s and you have long term care insurance and you are in a terrible accident and you are made a paraplegic. Well, now suddenly you not only have a major medical condition and you're going to need a lot of physical therapy and kind of retraining of your body to just function as a paraplegic, but you're probably going to be, depending on the severity of the incident and so on, in some version of a, inpatient care facility for quite a while. And so long-term care could trigger for something like that. Now, elimination periods in the policy where it doesn't pay for a certain amount of time before it really kicks in might take up most of that time, but there's a scenario in which you're a younger person who is struggling with activities of daily living that long-term care might actually pay for. So again, it's not just about being older or having dementia or something like that. There really is just a question of, can you complete day-to-day activities? The assumption is that they are going to be permanent, but they are not required to be permanent impairments. They just need to persist for long enough to exceed that elimination period.
Well, this might be getting off on a tangent, but then how is that different from having long term disability insurance? Is one better than the other in a situation like that?
Well, they're two different sides of the same coin here. Long-term disability, first of all, is not triggered based on ADL factors. So, for example, you might have, let's say, really severe long COVID, where your cognitive faculties are severely impaired, but you are not incapable of performing activities of daily living. You just can't do, let's say, rocket science anymore. So, there's cases where disability insurance might trigger when long-term care insurance doesn't, and vice versa. But also, they're structured very differently. Disability insurance is designed to replace the loss of income from the inability to work due to an injury or illness, whereas long term care is designed to pay for your ongoing assisted living needs.
Hmm. Okay. Okay. Well, is that part of why long term care insurance is so expensive then?
Well, so that's a big part of it. It's also that, unlike a lot of forms of insurance where the optimal insurance mix is a low probability catastrophic event, a ton of people need some assistance as they get older in age. About 70% of people are going to need some form of assistance before they pass away, if they reach, kind of retirement age and beyond. And so because of that, there's an extremely high level of utilization. In addition, we do not have enough beds or enough professionals who work in the long-term care space. So there's a supply demand problem that makes the services themselves very expensive. And so the economics of having a risk pool as opposed to something like health insurance, where health insurance is sort of just how we do healthcare in the United States. Long term care is uncomfortably close to that dynamic. And so it's been very difficult for insurance companies to make a profit. There used to be a lot of long term care insurance sold in the 80s and 90s, and the number of carriers offering it has dropped off significantly, and the types of policies have changed significantly because they sort of all overpromised and then had major funding problems related to their policies as their risk pools got to the age where they were actually using their benefits.
Which I suppose then also kind of answers my next point about a lot of people complaining that long term care insurance doesn't actually even have very good benefits, it seems like. It's not what they anticipated.
Well, I think a lot of that tends to come down to the terms and conditions. A lot of people like to think of their insurance company as the bottomless pool of money, but it's a contract. It's you shifting a risk onto that insurance company. And so a lot of the complaints around quality of long term care will be around things like whether they'll pay for in home care, whether they will pay for in-home care from a family member to replace their income to take care of you versus it needing to be a licensed or certified professional or from an agency or something like that, whether they will pay more or less based on the type of care, at home versus assisted living versus adult daycare versus memory care or something like that. And then within that, there's also the structure of how reimbursement or payment happens. Long-term care policies are generally structured with a daily benefit. So a very traditional version of a policy might be something like a $200 per day benefit that starts after 90 days and then lasts for up to 3 years. But that benefit may be paid in one of two ways. It can be paid as a reimbursement, meaning you have a 30-day month. It's let's say $200 a day for your care facility, so you need to pay the facility $6,000 for your room and board and upkeep and so on, and then you're going to submit the receipt or the invoice to your insurance company, and they're going to reimburse you. So it's a reimbursement style policy versus an indemnity policy, which essentially says, hey, when you have this triggering event, when a doctor sends us documentation saying that you have difficulty completing two or more activities of daily living and you are now receiving assistance or you're moving into an assisted living facility, we are just going to start sending you a check for $6,000 every month, rain or shine, regardless of how much cost you actually incur. So what a lot of people run into frustrations with long-term care policies is that they have reimbursement policies instead of indemnity policies, and then they get into an argument with the insurance company over what is or isn't covered because again, a lot of people have a bit of what's called a morale hazard, not moral hazard, but morale hazard. And in that particular context, it's essentially, look, I paid for insurance. Insurance needs to solve this problem for me. And the function of that is, hey, you do have a policy. Your policy has terms and conditions. And often people don't fully understand those terms and conditions. And they experience a lot of frustration and disappointment when their expectations do not equate to the policy that they've purchased.
Well, and are those reimbursement policies then quite a bit cheaper and therefore more people have those? And it was just kind of a misunderstanding when they purchased of how they all actually operated?
Yeah, I mean, just from a pure economic standpoint, a reimbursement policy is going to be cheaper because the insurance carrier is only on the hook to reimburse you for eligible expenses for your care needs, and you may not use the full benefit. So back to the $200 a day, maybe your care facility or your assisted living help only costs $4,800. Well, that's cheaper to them than sending you $6,000 a month for what otherwise might look like the same policy. So there are a lot of carriers that did a reimbursement policy structure, and a lot of people have been surprised by that because they just sort of assumed that it would be more like their home and auto where you're just going to get a big check for your needs and then you just kind of deal with it from there.
Right. Yeah, medical is always a little bit different, which kind of leads me to my next point here when we're talking about actual health insurance. I kind of want to go over just how that is structured as well, specifically at first around like large events, like a heart attack or you have a chronic condition that's long lasting, like cancer or something. Can we talk a little bit more about how that works?
Sure, but let me put one last pin in the long-term care topic here, which is, there's traditional long-term care, which is what I described, and there's a ton more to be learned about it than what we've already discussed so far. I don't think we solved long-term care in 7 minutes. But also the other forms of long-term care that are out there. There are annuities and life insurance policies that often come with chronic illness riders that'll give you buffers and bonuses for long-term care. Those are not as optimal as traditional long-term care insurance, just from a pure cost benefit standpoint, but they can be cheap additions to other types of investment or insurance products that are useful to have. And the thing that also is very valuable about those is the fact that a lot of them will be a lot easier to qualify for than long term care. Long term care, traditional long term care insurance, is by far the hardest type of insurance to qualify for, right? If you've ever had joint issues, knee replacements, if there's a history of dementia in your family, if you've been in a severe accident, if you are in an occupation that has a lot of wear and tear on your body, like there's a million and one things that can really get you disqualified quite easily from long term care. So those alternatives that are attached to life insurance or that are called asset based long term care policies, where you give the insurance company a chunk of change and they promise to pay a bigger chunk of change back if you need long term care. There's a lot of things like that out there that are also eligible in long term care space, but those are even more complex than traditional long term care policies. And they're also a lot more unique product by product.
Sure. Well, if long-term care is so difficult to qualify for, is there like a certain age that you kind of recommend people start looking into it? Of course, it varies widely depending on their medical history, but like an average that you kind of tell clients?
I really want to see people take it seriously as they get around the age of 50. And that is because as you get into your 60s, the probability that you've developed some sort of health condition, major or minor, is a lot higher than it is in your 50s. And then, therefore, your qualification and disqualification is a lot harder to clear. But your underwriting is going to be preferable in your 50s. But one of the issues that arises is that long term care insurance is expensive. It's going to cost you several $1,000s a year per person. And there's a whole dynamic here about whether you have individual policies or spousal policies where you sort of share one big pool of benefits. But it's a really big thing to take much more seriously, much earlier in your life than you might otherwise expect. Because the problem is a lot of people sort of wait for, as the analogy goes, the house to be kind of catching on fire to try to go get long term care insurance. And again, long term care insurance has been an industry that's had a lot of difficulty being profitable for insurance carriers. So the underwriting is ruthless and brutal. So it helps to really just try to take care of it well before you ever think it's a serious concern.
Sure. Well, and I think there's a lot of people that aren't aware very much what kind of an option they have in long-term care insurance. I've talked to a lot of people and they seem to think their health insurance is the one and only thing they have to look into and rely on as they get older to take care of them. And they don't realize there's a whole different type that they could purchase.
Yeah, and we could give an entire episode here on Medicare Part A and how that will pay for some of this stuff, and how Medicaid also kicks in and starts to pay for some of this stuff. But that, again, we could spend an entire hour just getting through the brass tacks of that, let alone getting into the nuances. So I will let you ask me about general health insurance stuff instead, and save that for another conversation.
All right. Well, then I'll ask again what I kind of brought up earlier about, health insurance in general. When you have a major health event, you have cancer, you have a heart attack, the big ones that people think about. How exactly does health insurance operate in a situation like that? I don't think everyone understands it.
So that's one that it really becomes quite challenging. First and foremost, we need to define some of our terms here. What we're going to discuss here are going to be Affordable Care Act traditional health insurance plans that meet all the Affordable Care Act provisions, where essentially it covers everything, and then it can't discriminate against you, and there's no pre-existing condition exclusions or anything like that. That's important to distinguish because there's an entire marketplace that's really developed over the last decade or two that caters towards essentially non-Affordable Care Act policies. So these are sometimes actual health insurance policies, but they have underwriting criteria and they don't comply with the Affordable Care Act. They resemble health insurance circa the 90s for anybody who's more familiar with what health insurance used to be like. And it's a much more traditional risk pool. So the idea there is you are going to get to pay less than you'd pay for an Affordable Care Act policy, but the carrier can drop you, the carrier can exclude things, and so there's just more limitations on the benefits, and therefore the cost is lower. We're also excluding things like healthcare or health sharing ministry type stuff, religious risk pooling products. Again, terms and conditions, they're all over the place. You have weird cases like getting into a car accident and the other driver was drunk, and so there's a DUI, and the ministry somehow says like, sorry, but there was like sin involved in your injury or your accident, so we're not going to pay for it. We're going to avoid all of those kind of weird fringe case things. We're really just going to focus on real health insurance that is federally mandated and regulated and so on. So that's the groundworks here. To your question then of how does it work when you have something big like, like a heart attack, cancer, some major event, the basic structure of pretty much all health insurance in the United States is going to be a tiered structure of deductible, and then meeting your deductible, and then hitting your out of pocket, and then in network and out of network considerations there. So generally speaking, your deductible is a number anywhere from $0 up to something like $8,500 for an individual, all the way up into 16, 17, $18,000 for a household, and essentially that part of your healthcare cost is on you. You are going to pay for that out of pocket, and your only benefit from insurance at that particular stage is that they may have negotiated preferable rates or copay arrangements with various medical providers and hospitals and so on, so that instead of paying $3,700 for an X-ray, you pay $250. You're still paying the full $250, but the insurance company has just negotiated a more reasonable cost for you. When you have something like cancer, you're probably going to blow through this deductible phase almost instantaneously. So then health insurance becomes more particularized around that period between meeting your deductible and your out of pocket maximum. At that point, your health insurance policy has to start picking up some of the bills. Most health insurance policies will do this in one of two ways. They will either have fixed costs for certain procedures. So you'll see something like, okay, you now have a $100 copay for x-rays and we'll pick up the other $150 that we negotiated. Or you'll see it structured as a percentage. So something like until you meet your deductible, all costs are on you. After your deductible, something like lab costs, so getting your blood run or tested, you will have to pay for 20% of those costs. Again, probably a negotiated cost, where if you didn't have insurance, it might be $22,000, but because you have insurance, it's $1,500. So then you have to pay 20% of it. So you pay $300 of the $1,500 cost, and the insurance company is paying the rest. When you hit your out of pocket maximum, at that point, your healthcare costs are essentially supposed to stop cold, with the exception of certain copay items or exclusions. And that gets into a pretty policy by policy niche. But the general idea here is, back to your cancer example, if you have cancer, you're probably going to blow through your deductible just in your first couple of exams and treatments, chemo or whatever procedures and testing you go through. Your insurance company is then going to start picking up the tab once you've hit your deductible up to a certain point. You're going to be responsible for a percentage of those costs. So to make up some numbers here, let's say, just for the ease of tracking, let's say your deductible is $5,000 and your out of pocket is $10,000. You're going to pay $5,000 just right out of the gate. And then let's say you're going to pay 20% of all your procedural costs for the next $5,000. So in that scenario, then for you to hit your out-of-pocket maximum of $10,000, you're going to have to incur $25,000 in healthcare expenditures, of which your insurance company is going to pick up $20,000 of, and you are going to pay for $5,000 of. And this is all on top of the $5,000 you already paid. So to hit your out-of-pocket limit, you're going to have incurred $30,000 in healthcare expenses. And then from that point, you may have like a copay or something that you're required to pay at point of service when you go to the doctor's office or something like that. But your insurance company is supposed to reimburse you for that and pick up the tab on all of that. There are some exceptions. There are some exclusions. This is where you really get into like page number 5 and 6 when you get the summary of coverage documents. Everybody has seen one of these. There's a universal template. It'll have the name of the type of policy at the top, and then it's a blue and white table where essentially just every row is blue or white, and it'll have, it'll start off with your deductibles, it'll start off with your out-of-pocket stuff, and then it'll start talking about copays, and then it'll steadily get into more and more detailed stuff: maternity, healthcare, chiropractic, surgery, inpatient hospital, outpatient hospital, and what your obligations are and what the carrier's obligations are when you incur those costs.
Okay. Well, are those specific exceptions and everything maybe what's happening? Because you hear all these stories, from just people and on the news and whatever, of people saying, oh, I went bankrupt from, my medical bills and I had insurance and it was a pretty good policy, but it was still astronomical costs and they didn't cover what they said they would. And, how does that happen if they have this out of pocket maximum, but they're still saying it was something that caused bankruptcy for them?
There are a couple of places this can happen. Number one, you're going to a provider outside of your network. So sometimes people say, like, I want to go see Dr. Smith, and Dr. Smith is the best oncologist in Colorado, and Dr. Smith's not in network. And so, you say, I want the best, and I'm going to go out of network, or I'm going to make that decision. Or I just didn't really think about whether they were or weren't in network, and I've incurred these costs, and then I've sent the bills to my insurance company. The insurance company looks at me and says, sorry, like, that's not part of the deal. You went out of our network. And so all the out of network costs and provisions apply to you, which is to say we will not cover a substantial amount of this because you went outside of our network. That's the sort of your fault version of it sometimes. And it's not to say that you wouldn't do it for that reason, but that's one example. Another thing, and this is, I think, a messier part that healthcare like really has got to get figured out because it's absolutely awful. Tons of people who work in healthcare are specialists, and they are contracted specialists. So, for example, a lot of hospitals and surgical centers have a W-2 staff of surgeons and nurses and medical assistants, people who run the place, but then they'll have some like some locum tenens doctors coming in for the week or the weekend because somebody else is out of the office on vacation. And so we'll have somebody like an anesthetist or a radiologist come in, and they aren't actually an employee of the hospital. They're just a contractor who's there for the week. And so they'll do your x-ray, or they will help you with your chemo, or they will, do whatever exams or procedures are there. And the medical billing world is so specific that when the bills go to the insurance company, they'll be like, cool, you went to our in-network facility and you saw an in-network doctor and another in-network doctor. And oh, but no, Dr. Jones here is not part of the network because he's just a contractor who happens to be in town this week. We don't cover stuff for Dr. Jones. And so suddenly you had this medical expenditure that you thought was in network because you went to an in network facility with in network payers. And suddenly there's an out of network provider in the building or in the room sending a bill that your insurance company is saying, sorry, they're not in network, we're not paying for that, and you are none the wiser to that. This is where some laws have come out around no surprise billing and certain standardizations of cost, but quite often it's just a literal exclusion. Hey, you have incurred a cost that we're not obligated to pay for, and so we're not going to. And that's obviously a big challenge and problem. I think there's then two other culprits here. Number one, most medical facilities have absolutely no idea what their services actually cost. There's a huge number of studies on this that show, for example, that they followed around a bunch of orthopedic surgeons and essentially followed them on things like hip replacements and knee replacements at one university system, and found that they were overbilling by a factor of 500%. They were saying, oh, the cost of this procedure is $54,000, but it was only costing $9,000 to actually perform. And the hospital didn't know. They had just sort of negotiated themselves into this very high level of expense. So then a big part of this can be that some of these uncovered expenses or things that are exceptions or exclusions from certain policies can just be outrageously overpriced, where even a small bit of care can incur an astronomical bill that has no relationship to the services you've received, and you have no reason to believe that they should be so expensive.
Well, and if there's something on your bill that is maybe, incorrect or whatever, can you argue that? Or once it's on there, you have to pay for it because it's already gone through the system and that's it?
So there's a couple of things that go there. I mean, first and foremost, you should always ask for an itemized bill if you have any complex procedure. And when I say that, like if you go to your doctor and you do like a checkup and you say there's a $20 copay, and you get a bill for like $70 because there was a lab test and you've got a little copay for that or something, probably just pay it. But I'm saying, if you go in for, let's say, the delivery of your child, or if you have a surgery, or if you are in an accident, you're in the hospital for a couple of days, request itemized bills, and they're required by law to provide them to you, because medical billing errors are rampant. There are tons and tons and tons of them. I don't want to say they're easy to find, but it is statistically common for there to be an error on a medical bill, or substantial bill errors, either in dollar amount or in quantity of errors. So that's one factor to it. And then beyond that, to your question of do you have to pay it, medical debt is unsecured debt. So there's no law that requires you to pay it back. It falls into the same category as your credit card. But if you don't pay it back, it will ruin your credit, right? I mean, it will be an unpaid liability. You will have negative remarks. It will eventually be sent to collections. And sometimes, your creditors may try to take you to court to force you to pay. And that is where you end up with the kind of rampant issue of medical bankruptcies, where some people go, well, I was in a car accident, and because I was taken to an out-of-network hospital with an out-of-network doctor, my insurance company was saying I was going to have to pay $290,000 to have my leg, because my leg was fixed and my life was saved in surgery. But I work at Starbucks. I don't have the income to pay this. I'm never going to be able to pay this off. So it's just better for me to go ahead and go bankrupt on it instead.
Right. Well, in a situation like what you just described, you're in an accident, maybe you're not conscious, you can't say, and the ambulance brings you somewhere. Is there anything you can do to even prevent that from happening? I mean, they don't know your insurance and they're trying to save your life, so they're not really focused on that. They just bring you to the closest hospital and you get a big bill. There's nothing you can do?
I mean, this is where we get into an area that sort of extends beyond the financial planning domain insofar as like what is your legal right to refuse service? If you're conscious, if you're unconscious, if there are issues as far as you refusing service, but then you seem impaired, so a law enforcement officer says no, he has to go to a hospital. We're really concerned about his well-being or her well-being. That's an area that I'm just not really qualified to opine on. But this is just a fundamental problem of the medical business model relative to any other business, right? If you got into a car accident and you were unconscious, and I tried to sign you up to pay $20,000 in planning fees for the next 10 years, justifiably you could get that thrown out in court. But the medical world is a weird world in which an unconscious dying person or an incapacitated person needs medical care, kind of period. And so whether you might be like, no, I can't afford it, if you were conscious and capable of objecting to it, the medical providers have this ethical obligation to help you, right, or at least to keep you from dying if it's within their ability. And then they have the right to bill you for that, whether you would have agreed to it or not.
Hmm. Well, on that positive note, I want to talk a little bit about health insurance, closer to retirement, which is something we do a lot more work around here. A lot of people want to retire maybe just even a couple years before they're eligible for Medicare, or, they want to retire at the same age as same time as their spouse, and one is eligible, one isn't, all that kind of thing. How do you recommend people handle insurance between, I've quit my job, I don't get it through work, but I don't get Medicare yet? What do people do in that gap period?
They hire financial planners to tell them whether they can afford it or not.
That's true. We do plenty of that. Is it just that simple? It's so situational that, you know, there's no good run of the mill advice for anyone?
There is no good run of the mill advice, but let's just talk about what's important to understand in the context of that decision. If you are over 50 and you're not yet 65, so you're not eligible for Medicare, you're probably paying somewhere in the neighborhood of anywhere from, let's say, $12,000 to $30,000 a year for a married couple to have health insurance. And that is going to vary substantially based on age and whether we're getting, let's say, a bronze plan versus a gold plan through an Affordable Care Act exchange. And the question of, what do you do in that scenario, or what's the best path for you, is, can you afford it? And what is your health status, and what are your potential medical costs, and what is the risk you're willing to bear? It's interesting because we do have plenty of clients who are able to self-insure, not that they shouldn't have health insurance, but that they can afford the premiums, even though they're very expensive, and they can afford even to, let's say, have a bronze plan and then have a catastrophic event where they might be out, $30,000-$40,000 in a year. They've got the savings built up to be able to eat that in the transition from being work optional to being 65 and being on Medicare. But a lot of people are scared of how much health insurance costs. They're just not used to paying that much because most people have some version of a subsidized health insurance policy. And by extension from that, as you get into the kind of space where it gets very expensive, right, 62, 63, 64, a lot of people just make the decision that they're just going to hold out at work because of health insurance, but because they're scared to pay for it. But at the end of the day, if you can afford to retire early and you have the cash flow, either because your spouse is still working or because you've built up the financial resources to be able to handle the premiums, then that's fine. It's just a matter of then understanding what your minimum costs are, your maximum costs are, whether there's catastrophic or no catastrophic event in your health, and then whether you're comfortable with how much that might eat into your savings, because it is going to be expensive. Again, we're talking minimum, 5 figures of just premiums cost, and then potentially, thousands and thousands or tens of thousands of dollars more in deductibles and out-of-pocket costs on an annual basis, potentially, in that early retirement all the way up to age 65 phase of life.
So some scary big numbers, but it is possible if you sit down and really do the math and figure out how much you personally can afford. It's really the only way to go about it.
Yeah. I mean, imagine a scenario where you've paid off your house, you don't have a mortgage cost, and your cost of living is minimum really just groceries and utilities. So let's say it's, $10,000 per person in your household. Could be a lot more, could be a bit less. Let's just say it's $10,000 a year that you need to live on. If you've saved, let's say, $2 million at this point and you're 50, okay, it's going to cost you and your spouse, let's say, $20,000 to live on from age 50 all the way up to 65. And then it's going to cost maybe another, again, $12 to $30,000 for health insurance. But you have a $2 million portfolio. So if we take something as lackluster as the 4% rule, you're supposedly able to have $80,000 you can spend annually in retirement and adjust for inflation with. And so your cost of living, even with this high health insurance cost, is lower than that potential distribution rate. So then in that particular context, you can afford it. It just may be more than you want to spend.
Right. Okay. Well, I don't want to get too into the weeds with actual Medicare, but is, thinking about gap policies and something that you would plan for earlier on when you're trying to see what you can afford, or that's just thinking too far ahead and you should deal with that when you start signing up for Medicare?
Doesn't hurt to think about, but the prices change over time and Medigap policies have been amended over time. So it's something where I wouldn't be like picking out my Medigap, version B at the age of 49. I think that really only matters to me as I get to like 63, 64, 65. And to the question of whether you do or don't need one, I think the basic answer there is you just want to go and look at the Medigap table, which essentially just summarily covers what all the different versions of Medigap policies do and don't cover, and see what concerns you and pick up a Medigap policy that covers anything that concerns you. And if nothing concerns you, then you're probably just fine with Part A, Part B, and Part D. Or if you really love your doctor and your network, you can do a Part C. But I'm not generally predisposed to recommending a Part C unless somebody just, absolutely can't live without Dr. Smith.
Right. Well, that's lots to think about. It's always a big question in financial planning. We go over that quite a bit. Which leads me to my final question here. Again, we're still talking about insurance, but now I'm switching to homeowners insurance. Anyone who reads the news even a little bit has obviously been tracking those big fires in LA that have been going on for several days now at this point. And so there's all these news stories now of, these big companies canceled people's policies right before they happened and XYZ, and it's so terrible. But, is that actually what's been happening? Can they do that?
So there's sort of a two things are true at once thing. A lot of people have had their policies canceled because the carriers don't want to insure a risk that they can't actuarially account for. And also that happens to have happened to a lot of people in the weeks and months or years leading up to these big fires. So take a carrier like State Farm. State Farm a couple of years ago essentially said we're not writing any new business in California, and we are severely pulling back on the policies we have written in California because California will not let us build our pricing models based on anticipated future risks. They will only let us build our pricing models based on what's historically happened, which is not how insurance is underwritten. All actuarial science is taking existing data and then taking all sorts of factors into account to try to project future outcomes. And from that is then reverse engineering an expected amount of loss and is then charging a pool of policyholders a certain amount of money to cover that expected amount of loss with a certain amount of buffer to it for operations, profit, and so on. To give you an idea, for a company like State Farm, they posted a several $100 million loss 3 years ago, 4 years ago. The year after, they posted something like a $5 or $6 billion loss. The year after that, they posted something like an $8 or $9 billion loss. When you go to insurance carriers and tell them, hey, you can't account for these risks in the way that you think is best for you, insurance companies are big financial institutions, but they are not bottomless pools of money. In fact, insurance companies even have their own insurance companies called reinsurers, where after a certain amount of claims, then the burden falls on these reinsurers. And so, if they cannot properly price for risk, they're going to drop policies. They're going to stop writing policies. I mean, here in Colorado, we've had a ton of carriers pull out because of all the hail problems and because some of the big fires. If you have a house in the mountains or a cabin in the woods somewhere up there, up on the mountains or anything essentially west of the Front Range, that you've either had to do a ton of mitigation stuff around your property as far as fire danger, right? Clearing brush, cutting down trees, keeping a big buffer around your property in case of a fire, or that your insurance carrier has jacked up your rates enormously, or they've just dropped you and said, sorry, we're not covering these anymore. If you live here on the Front Range, you've started to see a lot of changes in premiums, costs, or deductibles around things like hail damage, roof damage, siding damage, and so on, because it happens so frequently and it's so catastrophic that there's just a big issue with it. And so carriers are saying, look, it's too much. And in other states, Florida, New Orleans, not New Orleans, New Orleans not a state, Louisiana, areas along the Gulf Coast, a ton of them have had huge increases in their premiums because of all the hurricanes that have happened and the amount of damage that has happened due to hurricanes. So insurance is a business. And it's not great that people got dropped or that people lost their policies, that people's premiums are going up. But it is what it is, in the sense that, look, if big catastrophic events keep happening and carriers don't have the capital to pay for those losses, then they have to raise their premiums to cover those losses. That is pure economics. That is basic arithmetic. There's no magical world in which somehow magically the carriers can just have low rates and also pay to rebuild all of Los Angeles. It just doesn't work that way. And so there's a conspiracy theory minded thing where it's like, maybe the insurance carriers knew that their homes were going to burn down. No, but they had models that they couldn't price for where they said, yeah, there's a really high fire risk here. We'd like to charge more to cover for it. And the state said no. And so they've said, okay, well, then we're not insuring. Sorry, if we can't price for it appropriately, we're not going to cover the risk. We are in the business of insuring risk, not of just hemorrhaging money.
Right. Well, that makes sense from the insurance company's standpoint, but what are the policyholders supposed to do then? It seems like wherever you live, there's a fire risk or a hurricane risk or earthquake or something, And if all these carriers are unable to provide coverage and they're canceling policies and saying we can't do this, you can't really shop around. There's not as many options then, right? Like from what company to choose from?
Yeah, I mean, you do run into sort of unintentional monopoly problems in certain areas or for certain types of policies where there's really only one or two carriers who might insure your property based on where it is or the type of property. And consequently, both because of monopoly issues, but also just because of getting the risk pooling, right? If it was profitable to insure it, more people would be doing it or more companies would be doing it. Because it's not that profitable to insure, or because insurance companies don't think they can make a profit on it, those who do tend to have very high rates. And so, I mean, the unfortunate answer to your question is you either have to eat the cost, right, and go with one of the high carriers, or you have to self-insure, which let's just remember why there's not a lot of people insuring here. It's because they think there's a high risk. So if you're saying, well, I know I live in a floodplain on the panhandle of Florida and hurricanes blast through here, it seems like every other year, and I've had my house rebuilt 9 times because of flooding and water damage and all sorts of stuff. But I think now going forward, it's going to be safe. Like, I'm not saying it's great to have to pay $15,000, $20,000, $30,000 a year for insurance premiums, which some people are, but you're still stupid if you don't pay for it if the risk is that high. Like that is the tough scenario that's here is, yes, the cost could be prohibitive or unaffordable, and then you just can't afford it, or you're going to have to eat the cost. The only other version of this is some states have started to come with sort of insurer of last resort state programs. And these essentially are just tiny, itty bitty, tiny, brand new insurance companies in a weird way. California before these fires had something like 500 or like $350 million in like a state property and casualty insurance pool for sort of people who couldn't get insurance anywhere else. And that's not even remotely close. I think the calculated damages in LA now are already into the tens of billions of dollars. So, I mean, there's a serious problem here where, between loss of insurance, between limitations on what carriers can afford, between all sorts of factors here, there may be some people who just don't get their stuff rebuilt or who don't get paid out in what feels like a reasonable period of time. But this is very much a money doesn't grow on trees sort of problem.
Wow. What an uplifting podcast episode this is.
I aim to bring great joy, but also more than joy, candor. Insurance is an area where you have a lot of moral hazard and morale hazard, right? The word without the E and the word with the E, they're very different, right? But a lot of people, I think, back to our health insurance conversation, have been tricked by health insurance into thinking that their other forms of insurance should act the same way, in that we use health insurance as a proxy for a healthcare system, whereas every other form of insurance is designed to be a protection against a catastrophic but improbable event. Well, as events become more probable, a lot more people have gotten used to the health insurance experience. So in Colorado here, I know a lot of people are like, well, my roof's kind of old and I should replace it, but I'm just going to wait for a hailstorm to put some dents in it and then somebody else will pay for it. And that works just fine on an individual basis. That the individual incentive there is very clear, but multiply that by everybody in your risk pool. and say, okay, wait, if we're all paying in $2,000, $3,000, $4,000 for our homeowners, and we're all planning to take a $20,000, $30,000 claim for our roof in the next couple of years, how does that math out? And that really is sort of the crux of the problem here is we have a bit of an entitlement problem with insurance. We don't think of it as a risk management product. We think of it as a warranty program. And insurance companies are a business like any other. They have to make a profit or they're not in business. And if they don't make a profit, they can't build a risk pool that can cover the claims that are there. And that is just where we are.
Well, that's a very good summary and explanation of the different types of insurance. I think it's, as you said, not something everyone really understands because it is so different depending on the type of insurance.
Well, it's different based on all the different types of insurance, but also insurance writ broadly is generally the lowest category of financial literacy across all genders, racial groups, and ages. More people understand loans, more people understand cash flow, more people understand investments, but insurance is bar none the least understood category of finance because, like all the other areas, nobody teaches you about it, but it also happens to be sort of the least interesting, least sexy part of finance, and so nobody wants to learn about it. So congratulations, everybody who's listened this far. You've now learned something that very few people actually really understand anything about.
A depressing but very informative episode. All right.
There you go. Well, we'll cap it off with my favorite question, as always. Emily, here in the new year of 2025, what exciting things have you done or learned that you think our audience would benefit from hearing about?
Well, I'm very much so a New Year's person. I love resolutions and goals and lists and things like that. And that's very exciting to me. I kind of do it throughout the year, actually, but I like when everyone else kind of joins in with me in January. I know at the end of the year, we as a company kind of made some goals and New Year's resolutions, I guess, for lack of a more corporate term than that. But it was fun to do the personal ones as well and kind of look ahead. And this is much more of like a less technical answer and more of a soft answer. But I think balance is really important as people look back on the year and look ahead. You know, they tend to focus on what they didn't get done or which goals they didn't complete or, whatever. But maybe you made it 2/3 of the way towards a financial goal, or you took steps towards, going to the gym more often. Like you said, you were going to go every day and you didn't, but you went 4 times a week. That's still plenty. That's great. So I think, looking back, being patient, being gentle, and looking ahead, doing that same thing is kind of what I'm thinking about what I'm doing these days. But also I'm just someone who really, really enjoys that. So I might be more focused on it than you or anyone else.
You must have loved last week's podcast.
I did. And I'm not a podcast person, so I'm very particular about if and when I listen to any and all podcasts. So if I enjoy a podcast, even our own, that's saying something.
Oh, Emily, I regret to inform you that you are a podcast person because, surprise, you're on a podcast.
I know. I just never find the time to listen. Some people listen to 50 different podcasts, and I'm not that kind of person. It's a much shorter list for me.
That would be me. I'm the podcast person.
You certainly are.
The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.